Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. I recently did a video about my watch list. So what I like to do is once every 3 months I like to create a watch list of all the stocks that I would like to buy in the next 3 months, whether I own them or a new stock, whatever. I create the list. I do a little bit of research on Morningstar to find out the price targets, so the fair value of these companies, and then I create my own margin of safety and so on. So I did a video recently on that, and I said to you guys on that video, let me know if you would like me to put together a community watch list. Okay, and that's what you guys have done. So some of you had basically sent me a message through Instagram, and some of you wrote it on the comment. So I put it together, and that's what I'm going to share with you. So I'm going to try to make this video as quickly as I can. Okay, right, so the first company we're looking at, so if you've never seen this before, so what we're doing here, we've got the PE, we've got the current price of the stock, fair value. This comes from Morningstar. I like to use Morningstar because in comparison to other companies, they actually are quite conservative in terms of their predictions, in terms of their target prices and so on. Then I like to do a little bit of margin of safety. What I mean by this is something I've learned from a book called The Intelligent Investor that was written by Benjamin Graham, who was actually a professor for Warren Buffett. And what he talks about in that, the margin of safety is margin of safety. What that means is you're buying a stock, so you don't know what might happen. The stock price could change. Okay, the market might decide the stock all of a sudden is worth more or less, whatever. Anything can happen to the stock. Some bad news can come up and then it tanks about 10%. So you need to give yourself a margin of safety. Okay, so what I like to do is my range is from 5% to 15%. So the 15 is the highest I can go up. So some of the tech companies I might do 15%, because in the tech companies they have a very higher beta, and they can go up very quickly, go down quickly, and so on. If any stock, basically doesn't matter whether they're in technology or not, whether if I think this company carries a little bit of risk, okay, or the beta is too high, or I'm not really too comfortable, whatever, I will give myself higher margin of safety. And then we've got the ideal entry. So after that, we've subtracted from this to, and then that's what we end up, the ideal entry. And then we get the percentage of that price. So we can then see if the stock goes down in the next couple of days, let's say for example for this company 47%, then obviously it becomes a buy for us. So let's have a quick look of the companies. So these are, I think, about 11 or 10 companies that you guys have asked me to look into. So Clorox is the first company. As you can see, it has a 40 PE, which is very high. Current price is $149 per share. Fair value is $161 per share, and I've given us 5% margin of safety because it's a consumer staples company. Is basically they sell predictable products and so on. Although right now, in terms of dividends, is a different ball game. They might cut their dividends sooner or later because they are. I don't know. There's something going on with that company. I used to own it in my portfolio. I sold it a while back. So ideal entry right now is $153 per share, and it's actually 2% of basically undervalued at the moment, as you can see. Okay, so they do sell predictable stock products, and is very well known. So for that reason, I'm actually comfortable, okay, giving it 5%. Okay. Now the next one is Hershey's. Again, it's a consumer staples company. Currently trading $231 per share, and the fair value is 165. Sorry. Okay, I've given us 5%. 157 is the target. It needs to come down at least to 48% for us to even look at it. Next one is a Colgate. This is a company I own in my portfolio. Their price right now is $82 per share. 75 is the fair valued. $4 is basically the difference because it's only 5%. And then $71 is the entry, ideal entry, and it needs to come down on 15.5% for us to even look at it. Stryker is the next company, and this company is in the healthcare. It has a 41 PE, which is quite high. Again, $225 per share. The fair value is 200. I've given us 5%. and $90 per share is the ideal entry. It needs to come down at least to 18.5%. Eli Lilly is the next one. Again, is the healthcare company. Very high PE, $311, $262 per share. Well, that's what it should be in terms of fair value. I've given us 5%, and right now should be about 250. It needs to come down at least to 25% for us to look at it again. Cisco, one of the oldest companies, technology companies out there, very low PE, $46 per share right now. 54 is the entry point, and fair value 3%. So I've given $3, sorry, I've given us 5% because it's one of the older tech companies. They're very predictable business model and so on. Ideal entry, and they have a lower beta as well. So the ideal entry point right now is 51, is about 9% undervalued according to this. Okay, all of this information comes from Morningstar, as I said earlier. So next one is Mastercard, the company that you know very well. 36 PE, $356 per share, 367 is the target. 37, I've given us, I think, 10%. So I've given us 10% because this is a very high beta company, very expensive right now. So $332 is the ideal entry. It needs to come down at least to 7%. And to be honest, 7% for this company is not even that. It can change 7 to 10% within 2 days. That's what I mean by high beta. Okay, if the stock goes down today for a couple of percent, it goes about 3 or 4%, and the next day it could go down again 3 or 4% and become basically hit that ideal entry point. So don't look at this and say, oh, it's too, I can buy a little bit of it right now, because genuinely be patient. Okay, it will pay off. AMD is the next company, very high PE right now, $99 per share, 130 is the fair value. I've given us, I think, 15% because of the risk this company carries and the fact that it's got very high beta, and obviously right now is $111 per share. That's the ideal entry, but it's basically undervalued almost 10%. So that is actually not a bad one, but that PE really scares me. ADP is the next one, automatic data processing, is in technology company, 37 PE, $259 per share, $228, that's the entry, and I've given us 5% because it's one of the dinosaurs. This company has been around for a long time, but the fact that it's got a higher PE, maybe I should change that to 10%, I'll be honest with you, but it's already, it needs to come down at least to 20 to 25% anyway. Okay, so it makes no huge difference. Nvidia is the next company, and as you can imagine, they definitely have a very high PE, probably the highest in here, $188 per share, fair value 200. Okay, I've given us 15% as well. Okay, otherwise it would have been actually a buy right now, right? So 15% margin of safety. And again, this is really good because recently they came out and said, you know what, we might not even hit our target in terms of earnings the next quarter. So they are warning us already. So for that reason, I would like to basically see the stock come down at least another 10 to 15% before you can even look at it again. Okay, the next final company is Nike, 31 PE right now, $117 per share, 133 is the target. I've given us 5%, 126 is the entry point, and it's about 7% discounted right now. So again, I'm not a financial advisor, but I just wanted to give you a quick overview of some of the things that you've given me, right? Some of the stocks that you've told me. Now, out of all of these companies, I own Colgate. I think that's the only one I own in this list right now. So yeah, so what I will do if I were in your shoes, okay, and you're interested in any of these companies, then you do your research first, find out a bit more information, and then have your own fair values and so on, and then wait for it. Honestly, be patient. Trust me, even though the stock's just gone up so much in the last couple of days, in the last couple of weeks, honestly, it takes a couple of bad days before everyone change their mind and say stocks are the worst thing in the world and start selling again. And if you watched the last video about dollar cost averaging and so on, then just keep doing that and ignore the noise and wait for this interest and really focus on the margin of safety. This is the most important element when it comes to investing. Okay, you don't want to overpay anything. Even if the basically companies are telling you, yeah, it is actually a buy right now, give yourself a little bit of margin of safety. Because you know what? We don't know everything about these companies. These companies could be hiding things that we don't know that might come out tomorrow. So just give yourself a little bit of margin of safety just in case anything goes wrong. And as an investor, that's something that we should all be doing. I hope you're enjoying the videos. If you are, please like the video, subscribe to the channel. Let me know if you have any questions. Have a wonderful day. Assalamu Alaikum.